adopting the IFRS financial statement which have been issued by ISB. Morning to all of you. Welcome back. Today we have a session on INDAS 1. Today is the third session, guys, on INDAS 1 and overview. Right. For next 5 minutes, let's recap what we have done in the last two classes. Right. In the first class, what we have read about the INDAS. Right. What is INDAS? INDAS are nothing but accounting standards which have been issued by the Ministry of Corporate Affairs as per section 133. As per section 133 in consultation with the ICI. Right. Then we said there are two routes available. One is the adoption route, one is the convergence route. In India, we have taken convergence route. What is convergence route? That means we have introduced certain carve outs and carve ins while adopting the IFRS financial statement which have been issued by ISB. That means all the 100% IFRS, all the 100% IS, which is International Accounting Standard Board, International Financial Reporting Standard, and plus or minus, we have considered certain carve outs, carve in, and carve out. Right. Today we are going to discuss those carve outs and carve ins. Right. After that, we have discussed two type of different series which have been followed: IS1 till IS41, and certain standards have been deleted, and the new board, which is ISB board, they have issued new standards IFRS. Starting from IFRS 1, as of now, they have issued 17 IFRS till IFRS 17, which is insurance standard. Insurance standard is not applicable as of now. Similarly, in India, we have followed two series: INDAS 1, INDAS 2, INDAS 7, and INDAS 101, 102, and so on till INDAS 117. INDAS 117 is not applicable because INDAS 117 deals with insurance companies, and on insurance companies, we do not applying INDAS as of now. Right, so that means INDAS 116 is applicable. All the IFRS standards in the form of INDAS are applicable till INDAS 116. As of now, how many standards are applicable? As of now, we have 39 accounting standards which are applicable, guys. Right. Then we talked about the applicability criteria of INDAS. To which company INDAS is applicable? So we said entire economy has been divided into three parts: company, NBFCs and bank, and the insurance sector. Companies, MC has taken care of the companies. RBI has taken care of NBFCs and bank, and for the insurance companies, IRD has taken care of. So all these regulatory body has issued roadmap, INDAS applicability roadmap for these respective areas. For example, MCA for companies, RBI for banks and NBFCs, and IRDA for insurance companies. Correct. What MCA said? MCA again divided the companies into two parts: bigger companies, larger companies, and mediocre companies. Larger company means any company having a net worth of 500 crores or more. 500 crores or more as of 31st March 15, as of 31st March 16, then INDAS will get applicable as on for the first period 16-17. Right. And once a company is covered, it holding subsidiary JV, all are covered. Correct, guys. And in the phase 2, any company having a net worth of 250 crores or more but less than 500 crores as of 31st March 2017, then INDAS will get applicable in the next year, which is 2017 and 18. Right. And what we said, when a company will prepare its first INDAS financial statement, what will happen? For the phase 1 companies, 31st March 17, 31st March 16, and 1st April 2015. That means it was the first time when the company will be presenting three financial statement, three balance sheet. Right. But how many profit and loss account? Only two profit and loss account. Right. How many profit and loss account? Only two profit and loss account. Right. What else? Then we said P&L needs to be prepared for 2 years. Cash flow needs to be prepared for 2 years. Statement of changes in equity needs to be prepared for 3 years because it is a balance sheet item. Right. And we need to give the notes to accounts and disclosure. Notes to accounts pertaining to the balance sheet is for 3 years, and notes to accounts pertaining to the P&L is for 2 years. Then we need to give equity reconciliation for the transition date, for the comparative date, and we need to give profit and loss reconciliation for the comparative period. Right. So all these statements needs to be given in the financial statements for the first time adoption. Correct, guys. Then we said for the NBFCs and banks, again for the banks it has been deferred for the till the next notification to be issued by RBI. That means as of now INDAS is not applicable to banks. Right. NBFCs 31st March 19 and 31st March 2020. Right. These are the two phases. Phase 1, any NBFC having a net worth of 500 crores or more, and in phase 2, any NBFC is having a net worth of 250 crores or more but less than 500 crores. Right. And if the holding is covered, if or any company is covered, its holding, subsidiary, JV, associate, all are covered. Right. And any listed company which doesn't get covered in the phase 1, it will get covered in the phase 2. What is company? Company means any public company, private company, unlisted company, listed company. Right. Any company which get registered under section 8, all are covered. What is listed company? A company whose equity or debenture are listed, whether in India, whether on any recognized stock exchange, and that stock exchange can be in India or outside India, INDAS will get applicable to that company. But there are certain organizations on which INDAS is not applicable. For example, partnership firm, LLP. Partnership firm, LLP, What else? Trust, society, banks, insurance companies, any company which is registered on the SME exchange, sole proprietorship, Index is not applicable. Branch office, Index is not applicable. Right? Question arises, sir, what is net worth? Net worth. Which standard provides us the guidance on the net worth? There is no standard which provides us the guidance on the net worth, guys. It's Companies Act Section 2, subsection 57, which says share capital plus reserve and surplus minus revaluation reserve minus revaluation reserve minus amalgamation reserve and minus miscellaneous expenditure which has not been written off by the company. Then what I will get? A net worth. Right, and this net worth needs to be tested as per the standalone financial statement, as per the audited financial statement, as per the Indian GAAP audited financial statement. It is not to be checked as per the consol financial statement. And once a company is covered, its holding, subsidiary, JV, all are covered. If you remember in the last class, we have talked about lots of scenarios. One of the scenario is if the company is covered, its holding covered, subsidiary covered, JV covered, and associate covered, but its fellow subsidiaries will not be covered. Right? If there is an associate, if there is a company and there is an investor, right? There is an investor, let's say investor is holding 25%. Index is applicable to that company, but index is not applicable to that investor because that investor is not a holding company, guys. What else we have read in the last class? We have read Index 1. We have read Index 1 in the last class, which deals with the presentation of the financial statement, which deals with the preparation of the financial statement. Then we said, what are the different guidance which are available for the presentation and the preparation of financial statement? We said there are three guidance are available. One is Index 1, right? One is Index 1, second one is Schedule 3. What is Schedule 3? Schedule 3 is nothing but a guidance which have been issued by Ministry of Corporate Affairs in the Companies Act, right? There are many schedules. As of now, they have issued from Schedule number 1 till Schedule number 7. Schedule 2 deals with useful life and depreciation. Schedule 3 deals with the preparation of the financial statement. And we said in the last class, the guidance which have been provided in Schedule 3 is not in contravention of Index 1 guidance. It is in substitution of the Index 1 guidance. That means if a company is preparing its financial statement for the first time or for any subsequent accounting period, the company has to follow Index 1. The company has to follow Schedule 3 as well. Right? So Schedule 3 is the another guidance for the preparation and presentation of financial statement, guys. And also in the past, ICA has issued guidance note on the Schedule 3. It's a detailed guidance note. That means if a company is preparing its financial statement, the company is required to follow all the three guidance in order to prepare its financial statements. Correct? What else we have read in the last class? We read what are the different components of the financial statements. Right? We said balance sheet is there, P&L needs to be there, cash flow needs to be there, statement of changes in equity needs to be there. What is statement of changes in equity? It is nothing but a share capital and reserve and surplus. Right? Notes, returns, disclosures. All these statements needs to be presented. Then we talked about characteristics of the financial statement. That means what is the characteristics, how the financial statement should be look like, what are the different features the financial statement should be having on this. One is the true and fair view. Very important statement we have mentioned that the company has to provide explicit and the unreserved statement in the financial statement for the compliance of NDAs. What we said, that means there is no reservation. There is no reservation of the compliance of any standard. Company cannot write in its financial statement that out of 39 I have complied, 38 one I am not complying. If that is the scenario, it means those NDAs financial statements are not in compliance with NDAs, right? But if the company has given the statement, if the company has given the statement, company has complied all the NDAs and company has mentioned the explicit and the unreserved statement in the financial statement of compliance, then even then if the auditor is of the different view for any particular transaction, right, from the company, then even then those financial statements shall be considered in compliance with Index. Auditor can have different view, different perspective on a particular transaction. Company may have different view on a particular transaction, right? But it does not mean financial statement is not in compliance with that. Okay. Going concern, very important. Going concern, the financial statement needs to be prepared on a going concern basis. Right? That means business of the company will continue in the future as well. But if there is any scenario, any event or scenario which may cast a significant doubt of the entity's financial statement to continue as a going concern, that needs to be disclosed. Accrual basis, we are following accrual basis. Since class 11th we have read accrual basis of accounting, guys. Accrual basis of accounting, we are not following the cash basis of accounting except in the cash flow statement, because in the cash flow statement we need to follow actual cash paid and actual cash receipt, right? So we are following accrual basis of accounting. Materiality, so materiality needs to be considered while preparing the financial statement, right? Materiality, whether a particular item is material, it needs to be disclosed separately in the financial statement. If there is any immaterial item, for example printing expense, for example stationery expense, company may club these expense together in the miscellaneous expense. So the materiality needs to be considered while in the preparation of the financial statement. Correct? Offsetting, offsetting means what? Can I offset the asset with the liability? Answer is no. Can I offset revenue with the expenses? Answer is no. If I offset asset versus liability, if I offset revenue versus expenses, then there is no need of preparing the balance sheet, then there is no need of preparing the P&L. I will only have profit and reserve and surplus. Right, guys? So that means we cannot offset assets versus liability, we cannot offset revenue versus expense, but there are certain standards which provide certain guidance that the particular expense, particular item can be netted off. For example, revenue recognition, discounts. Ind AS 115 says those discounts needs to be netted off. right? If the company is operating as a principal or agent, right? We have discussed in the last class. If the company is operating as a principal or agent, any commission paid to the agent, so agent will recognize that commission. Agent is not supposed to recognize the gross income. In the balance sheet side, Index 2 says that the provision for obsolescence of inventory needs to be netted off from the inventory. If the company has credited the provision for doubtful debt, that needs to be netted off from the debtor itself. So there are certain standards which provides what kind of transaction needs to be netted off. Correct, guys? That is what the offsetting is. Consistency. What is consistency? That means the financial statement needs to be prepared. Financial statement needs to be presented in the same and the consistent manner. It should not be the case that the financial statement presentation keeps on changing on an year by year basis. It should be changed if the change results into a better presentation of the financial statement from the reader perspective. Okay, what else? Frequency of financial statement. When financial statement is to be prepared, first of all, financial statement needs to be prepared at least for the period of 12 months. At least. Company can prepare annually, company can prepare half yearly, company can prepare 9 monthly, company can prepare monthly, or company can prepare quarterly. And anyways, listed companies are preparing quarterly financial statement as mandatory. Right? Comparative financial statement. Do we need to give the comparative financial statement? Yes. We are supposed to give the comparative financial statement as well. Right? Those financial statement which does not have comparative cannot be acceptable. Correct, guys? So these are the key characteristics which we have read in the last class. What else we have discussed? We said operating cycle. If there is any time gap between the acquisition of assets for processing and their realization is termed as operating cycle. Right? So if there is any amount payable or receivable within the operating cycle, receivable means trade receivable, payable means trade payable, then it will be considered as current in nature. Right? We have read the definition of current and non-current in the last class as well. Right, guys? So what we are going to discuss today, we are going to discuss some carve outs and we are going to discuss lots of questions which is given in the study map today. Right, guys? Let me take a pause now and let me understand if there is any doubt. If any person is having any doubt,